Good morning, everyone. Welcome to our Phillip Securities Research Morning Call for the 6th of December, 2021. So for today we have a couple of stock counter updates and followed by several Phillip on the ground updates. And we'll end off with our usual Singapore weekly. So just take note that the last morning call webinar for the year will be next week, the 13th of December. And so after that, we'll be taking a short break until next year. So without further ado, I'd like to pass my time now on to Natalie to move forward. Thank you.
Thank you, Jonathan. Good morning, everyone. So we'll kick things off with Manulife US REIT. This is an update with regard to their most recent acquisition announcement. Okay. So Manulife announced that they will be acquiring 3 new office assets located in high-growth Sunbelt and magnet cities of Phoenix and Portland. So 2 assets will be acquired in Phoenix, Arizona, and 1 in Portland, Oregon. Okay. Total consideration for these 3 assets stands at $201.6 million, and this represents a 2.3% discount to valuation. This will increase AUM by about 10.5% to $2.18 billion. The acquisition is DPU accretive based on a 59% assumed loan to value ratio. The DPU we will expect a 4.4% DPU accretion. Okay. So cap rates for these assets range between 5.8% to 7%, and this acquisition will increase Manulife's exposure to tech and healthcare tenants from 9.5% to 12.8%. However, Manulife is still playing catch up to its peers, Prime as well as Core Pacific Oak, which have 32 and 38% exposure to STEM and TEMI sectors. So the submarkets of Phoenix and Portland have benefited from population growth of about 15.6% and 12.9% over the past decade, and this was due to lower business costs for tech companies that is specific to Phoenix, as well as high proportions of skilled talent in the STEM and TEMI sectors. So once again, STEM refers to science, technology, engineering, mathematics, while TEMI stands for technology, advertising, media, and information. Yep. So these are part of the new economy kind of asset classes, which are enjoying secular growth. Okay. Another bonus is that in-place rents are currently between 9 to 14.7% below market rents. So this should provide some nice reversionary upside for Manulife during the next major renewal period in 2024. So in terms of outlook, post-acquisition gearing is relatively high. It increases slightly from about 41-42% to 43%. And it's on the high side for S-REITs. That means that further acquisitions will have to be supported by equity fundraising or divestments. So new mutations and waves of the COVID-19 virus may push back return to office, so that might also hamper or delay the recovery of car park income. And we are seeing green shoots in the US office space. So subleasing, tenant incentives, and rent-free periods are starting to pull back. We maintain an accumulate and DDM target price of 84 US cents. We have not moved our numbers pending the completion of the equity fundraising and acquisition. So at this price level, Manulife is offering a FY21-22 DPU yield of 8.2 and 8.7% respectively. So now moving on to the next counter, which will be Digital Core REIT, and they will be we are expecting this is the IPO update. Also, we expect the units to begin trading on the SGX at 2 p.m. today. All right, so do take note that we have no coverage for this counter, and the offering price is actually 88 US cents. Okay, just on the portfolio details. So this portfolio of 10 Okay, so the portfolio is a 90% stake in 10 data center assets valued at $1.4 billion on a 100% basis. So these assets, as you can see in the picture on the right hand side, 4 of them are located in Silicon Valley, 2 in Los Angeles, 3 in Northern Virginia, and 1 in Toronto. DPU yield based on the IPO price of 88 US cents stands at 4.75%. And for the portfolio, there's between 1 to 3% rental escalations for virtually almost all of their leases. And 80% of their leases are actually based on triple net basis. So what triple net means is that the tenant is responsible for taxes, insurance, as well as maintenance and operating costs. So some of the operating costs include like security, cleaning, as well as passing through of various utilities, water, as well as electricity. So this actually means that digital core will be sort of largely protected by any increase or inflation in these kind of prices. Occupancy for the asset is at 100% with a portfolio occupancy is at 100%, and portfolio WALE stands at 6.2 years. So most of you know the sponsor for this REIT will be Digital Realty, and they will have about a 39% stake in Digital Realty REIT. So earlier I mentioned that the portfolio is for a 90% stake in these 10 data centers. So the remaining 10% is actually held by Digital Realty. And including this 39% stake through the REIT, this actually represents an indirect interest of about 45.1% in the assets. This is a bit important. I'll explain a little bit more later. So Digital Realty has actually offered a digital core, a ROFO pipeline of about 281 data centers, and these are stabilized assets or soon to be stable assets. And this totals about 13.7 billion US dollars. Gearing right out of the gate is relatively low at 27%. And this is done deliberately. Also, the cost of debt for this for digital core is relatively low at 1.1%. This is due to the usage of floating rate loans. Okay. So due to the low gearing of 27%, debt headroom is about 160 million to 442 million to reach 35 and 45% gearing respectively. Okay, so earlier I mentioned that this low gearing is done deliberately so, and because the management would like to demonstrate that not only do they have this ROFO pipeline available, they are able to tap it. So they want to demonstrate, this ability to acquire from the ROFO pipeline. So we can expect that to happen in the near future. Okay, and also because the sponsor, owns an indirect stake of about 45.1%. So, the sponsor is incentivized to divest to this REIT because not only does it allow the sponsor to, monetize or rather recycle some of their money, capital from these stabilized assets, the sponsor will still be able to retain a significant interest in these assets through the 10% stake as well as through the REIT. Yeah. So it's a nice alignment of interest right there. Do take note that the public tranche is relatively small for digital core. Only 2.5% of total units offered are for the public tranche. Okay. So this next slide here just shows the four key markets in which digital core will have their assets in, as well as the major players in these respective markets. So Northern Virginia is actually the largest data center market in the world. About 70% of the world's internet actually passes through there, and it is home to a lot of big names: Amazon, Microsoft, Oracle, etc. And also, so for Los Angeles, it is the entertainment capital of the world, and that is where some of the data center needs actually stems from. your entertainment companies, Northern California as well, for tech companies, and Toronto, which is an important business and financial capital in Canada. Okay, so next slide, please. This is the last slide for digital core. The data center space has actually seen some consolidation amongst the listed players. So as you can see in the graph, Digital Realty as well as Equinix, these are the two largest players in the data center space. And then followed by CyrusOne, QTS, and CoreSite. And the consolidation that has happened is actually taking place amongst the within the three smaller, ranked 2 to 5 players. So in August of 2021, Blackstone actually acquired QTS Realty, and just last month, 15th of November, the two other data center REITs that are being acquired are CyrusOne as well as CoreSite Realty Corp. Yeah, so that just means that moving forward, it might be a little bit hard, more difficult for players to actually want to acquire data centers, and it does help Digital Core. They do have this ROFR pipeline available. Yeah, and not to mention, if you look at Capital DC and you look at Digital Core, eventually the growth will have to come from inorganic growth, which is acquisitions, and that is where the ROFR pipeline is actually very important for the growth. Okay, so that's all for me. I would now like to pass the time on to Vivian.
Thanks, Natalie. So I'll be covering LHN's FY21 results, and the company continues to tap into evolving real estate trends. So next slide, we will be doing a quick recap on LHN first, because they have quite a number of segments, as can be seen here. And if we were to start from the left, so for industrial, residential properties, and also commercial properties, they lease or acquire these properties, refurbish them before renting or leasing out to their tenants or customers. So for example, under industrial properties, they have this work plus store outlets, which are 70% occupied by e-commerce tenants. And for and what differentiates them from other property investors mainly is that they provide this value-added services. So for example, for work plus store outlets, because their tenants are e-commerce players, so they partner with last mile delivery companies to provide delivery services. And they also have car sharing services and even EV or electrical vehicle charging stations. For the co properties or co-living spaces under residential properties, some of the rooms are equipped with kitchenette, washing machine, and they also provide cleaning services every other day. And for rooms that are not equipped with this, for example, in the picture, they also have common spaces where you could invite your friends over for gatherings and to cook a meal, etc. But of course, this is talking about pre-COVID conditions. Moving on to the next segment, which is facilities management. So they manage car parks and also provide cleaning and related services. And lastly, under logistics services, they operate container depot that repair, clean, and inspect containers. And for transportation, they also transport dangerous chemicals in Singapore, Malaysia, and they also started doing cross-border trucking in the beginning of this year. So in the next slide, we'll be looking at their results, which were actually below our expectations, with FY21 revenue and profit at 89% and 84% of our forecasts respectively. This is mainly due to the lower revenue, which I'll be explaining more in a bit. So to start off with the positives, there was higher profit contribution from both industrial and co-living properties, as highlighted in the red boxes. For industrial properties, you can see that it turned around from a net loss to a net profit of about $10.9 million. And this was mainly due to the disposal of loss-making properties and also high work plus store occupancy at about 99%. And as mentioned, this work plus store are self-storage spaces. Co-living occupancy is also high at close to 100%. And next, we also see higher revenue and profits from the facilities management segment, with the revenue increasing 40% and the profit increasing 85% to about 18.6 million, as shown in the third last line in the chart. So this was due to the acquisition of the 33 JTC car parks in January 2021, and also the joint venture acquisition of Bukit Timah Shopping Centre car park in December 2020. There was also higher demand for other facilities management services during the pandemic, including that of cleaning and related services. So moving on to the negatives, revenue was lower, falling by about 10% due to the streamlining of operations. So for industrial properties, there was the expiry of 4 master leases in FY 2020, and for commercial properties, 3 master leases expired in FY 21. Commercial properties also suffered a net loss as there was lower demand for office spaces during the pandemic. As you can see from the chart, the occupancy was at about 85% for FY 21. So a quick conclusion here, the main revenue and profit contributor, please go back to the previous slide, was facilities management for FY 21 due to the acquisition of the 33 JTC car parks and also the expiry of 7 master leases in total for its industrial and commercial properties. Yeah, next slide, please. Moving on to other updates, LHN continues their plans to aggressively expand the Koliu co-living portfolio. So for FY22, we are expecting the commencement of operations of 5 residential properties. And with that, we are anticipating the addition of about 200 keys to the portfolio, which represents a 25% increase. Recently, they also announced the acquisition of the Mount Elizabeth property, which has a total of 22 stories. Next, they also announced the proposed spin-off and separate listing of LHN Logistics on the Catalyst. So this will be providing the logistics business with a separate platform to attract investments for further expansion plans of both the container depot and transportation businesses. If we compare to other local listed logistics peers like GK Corporation or Vibrant Group, these companies are currently trading at an average of about 14 times price to earnings ratio. They have submitted the applications to both Hong Kong Stock Exchange and Singapore Exchange due to the dual listing status, but there is no guarantee that it will be approved. So we maintain a buy call, but with a lower target price of 49 cents, down from 54 cents. FY22 PATMI has been lowered by 16% to $33.8 million on the account of lower forecast revenue contributions from residential and commercial properties and also facilities management as compared to the previous forecast. The target price is pegged to 7 times FY22 earnings, down from 9.5 times, still a 50% discount to the industry average. For FY22, growth drivers include the new Koliu properties and also the new Work Plus store outlet at 202 Kallang Baru in the picture on the bottom left, which is currently the largest property that they have in the Work Plus store portfolio. So that's all for LHN. I'll now be moving on to cover Phillip on the ground for Marco Polo Marine's FY21 results. Next slide, please. So Marco Polo is a regional integrated marine logistics firm. They have 2 main segments, ship repairs and building operations, under which they operate a shipyard in Batam in Indonesia. And the second segment is ship chartering, under which they have about 13 vessels and 24 tugs and barges. And for FY21, Marco Polo reported the highest operational EBITDA since the debt restructuring exercise in FY17. FY21 revenue grew 49% to $46 million, and they also turned around from a net loss in FY20 to a net profit of about $14.8 million. Revenue growth for FY21 was driven by higher revenue from both segments. And firstly, for maybe the shipbuilding and repair operations first, they saw record shipyard revenue since the debt restructuring, as can be seen from the graph on the chart on the top right. So for this ship repair and building activities, the utilization of the 3 dry docks was higher at about 86% in FY21. A few reasons for this. So firstly, there were ships that used to patronize Singapore that went over to the shipyard in Batam due to the labor shortage issue during the height of the pandemic. And after engaging these services over at Batam, these ship operators or owners realized that they could actually save on these costs about 15 to 20% lower. And the quality of services were also comparable, as it was operated by Singaporeans also, and they decided to continue to go back to them. And secondly, they also benefited from the implementation of the ballast water management system. There was also the generation of shipbuilding revenue from the construction of the 2 smart floating fish farms during the financial year. So expansion plans for this segment include expanding the shipyard capacity for more ship repair activities as they saw strong demand, and works for the extension of the Dry Dock 1 is expected to be completed by January 2022. For the next segment, which is ship chartering, the revenue is also at its highest since FY18, and utilization rates are also higher, for this driven by strong oil prices and demand from offshore wind farms. So the management shared that about 50% of the fleet is due for renewal by the first half of FY22, and they are expecting that these fleets can be renewed at higher charter rates, as you can see from the chart on the bottom right. So charter rates have recovered slightly, and although operating costs are also expected to go up, but margins are still expected to expand. The management also shared that they could earn possibly higher charter rates from supporting Taiwan offshore wind farms, as there are restrictions to the type of vessels allowed to work there. Future plans for Marco Polo include completing the increase in stake in PT-BBR, which is the Indonesian marine logistics firm, to strengthen their foothold in Indonesia, deploy more vessels to support the Taiwan offshore wind farm sector, and explore new opportunities in the renewable and sustainability segment. So that's all for Marco Polo. I'll now be passing the time on to Timothy for Marathon Digital.
Hi, thanks, Vivian. Next slide, please. Okay, I'll be going through Marathon Digital Phillip on the ground based on, because they did a webinar with us last week. Just about them, Marathon Digital is one of the largest Bitcoin miners in the US. So currently they hold about 7,400 Bitcoin, estimated to be worth about 361 million. They have a market cap of about 4.2 billion. At the moment, they have about 8% of the global hash rate. So hash rate is another way to say computing power, which is used to mine for Bitcoin. So 8% allows them to mine about 75 Bitcoin per day, or 8% of the total Bitcoin mine per day. So every day there's a total of 900 Bitcoin mine. So Marathon can get about 8% of that, which is about 75 Bitcoin per day. And they mine it at a cost about $6,200 per Bitcoin. So we went through a lot of details in the webinar, but I'll just go through how Bitcoin mining works, how they actually mine Bitcoin at the moment, just for learning sake. So what Marathon does with regards to Bitcoin is, first of all, they help to validate Bitcoin transactions. So Bitcoin miners like Marathon Digital, they gather all the transactions made through Bitcoin and lump it into this thing called a block, or simply just a list of transactions. And then after they lump it into a block, they verify if the transactions are made by the right person. This is done through a digital signature that only the real person who is sending the Bitcoin has that signature. So if someone else tries to create a fraudulent transaction in your name, they cannot, because they need your signature, and this signature is impossible to guess it, because the combinations, there's 2 to the power of 256 combinations to this password, and it changes every time based on the transaction that you make. So it's impossible to guess it. So the miner, like Marathon Digital, they help to determine if the transaction has the correct signature made by the sender of the Bitcoin, so that no one else can create a fraudulent transaction. And after they determine it has a good correct signature, that validates the transaction, and that is allowed to go through. So the Bitcoin miner gets a transaction fee from this. So this transaction fee is optional for the Bitcoin sender to pay, but because Bitcoin only can process about 2,400 transactions per block, meaning every 10 minutes, on average, every 10 minutes, they only can process about 2,400 transactions. So people who send Bitcoin are incentivized to pay a fee, so that the Bitcoin miners choose to validate their transactions, and their transactions can get processed faster. So right now, the average transaction fee is about $3.35 per transaction. So, but Bitcoin miners don't really earn much from transaction fees. So Marathon doesn't really earn much from this. What they really earn the most from is through this thing called securing the decentralized blockchain. Because Bitcoin is decentralized, meaning that no one has control over the transaction data. Not one organization has control to this transaction data. This transaction data is like a ledger, also called a blockchain. So this ledger tells you how much people owe you, how much people owe other people, how much people have paid other people, etc. So it's all the transaction data. No one entity controls this, not like a bank or a government. So that's why it's called decentralized. But instead, this data is public, so everybody has this ledger in their hand. But in order to make sure that people cannot cheat or fraudulently edit this transaction data, so that they can, let's say, double spend their Bitcoin to sort of make it look like they have more Bitcoin than they have. This concept called proof of work is used to prevent this fraudulent activities and the decentralized ledger. So, and this proof of work concept, it hinges on this thing called cryptographic hash. So if you look at it, if you look at the random long string of numbers at the bottom there, so miners have to guess a number which, when it's encrypted, produces a hash that has greater number of zeros than a set target of zeros. So if you look at this long string of numbers at the bottom, it has about 17 zeros there. So what the miner has to do is they have to guess a specific number that, when it is encrypted, produces a number that has more zeros, at least has more zeros, or has at least that number of zeros in this whole big long hash number. And I mean, it may seem easy, but it's really very, very hard. So right now, the probability of you guessing this one number as of September this year is 1 to the 1 over 79,000 billion times to guess it. So the chance is like 1.2 times 10 to the power of negative 25% chance of guessing that number. So every miner in this world is trying to guess this number at the same time. And the difficulty is set in a way that this number, this hash, can be guessed within 10 minutes in average. Okay, so the proof of work concept that secures the decentralized blockchain, the ledger, from being fraudulently hacked is this thing called proof of work. And whoever guesses this hash is rewarded 6.25 Bitcoin. So, and they can update the latest transaction data into the ledger. Okay, we'll talk about it, why this is important. So basically every 10 minutes, 6.25 new Bitcoin is added to the whole ecosystem. So that's the inflation rate at 6.25 Bitcoin per minute, per 10 minutes. And it's important why it's very hard to guess this hash. First of all, it prevents fraud. So how do you actually enter a fraudulent transaction? It's not just you don't have to guess it. You don't just have to guess it right one time, and then you can guess, and then you can put your fraudulent data inside. You have to guess the number correctly 6 times. You have to guess the number correctly, first of all, faster than everyone that they're trying to guess the number 6 times. So that's almost impossible. So the probability of that happening is almost impossible. The second thing that why it has to be hard and why Bitcoin miners are needed for this is because it prevents ultimate control. So if a Bitcoin miner has a lot of the computing power, more than 50%, it makes it much easier for them to guess the number 6 times in a row, faster than everyone else. So that's how having more miners in the system makes it harder to insert fraudulent data into this blockchain. Yeah, so I hope this helps to clarify what a Bitcoin miner does and how they earn money based on how they validate transactions and also secure the system from being from fraudulent transactions. Okay, that's all from me. I'll pass the time on to Terence.
Thanks, Timothy, and good morning, everyone. We hosted China Shenshan Orchard last week. Next slide. Sorry, there's a bit of lag on my side. I'm not sure if it's the same for everybody as well. But I'm just waiting for the slide to change on my side. Yeah, it's changed for me already. So we hosted China Shenshan Orchard last week, and we are providing a summary of this as part of our Phillip on the ground. We do not have any coverage on the counter. So just some background on China Shenshan Orchard. They are established in 2009. They are a kiwi fruit producer in China and the first SGX listed pure play kiwi fruit producer. They own one of the largest domestic kiwi fruit orchards concentrated in Cibi City, Hubei Province, China. So you can see some of the fruits that they produce on this image here on your right hand side. They have the Yanong number 1 and number 3, and then they have the Xianwo number 2 and number 4. So the difference between the different types of fruits here, the kiwi fruits here, is the texture and the sweetness of the fruit. So what are the key and main strengths of China Shenshan, they say, is the end-to-end value chain that they have, and their kiwis are sold through 3 existing channels. The first is through distributorship, the second is through wholesale, and the third is through e-commerce platforms like Tmall.com, Taobao, and JD.com. For FY 2019, their revenue and profit are at 99.5 million RMB and 53.4 million RMB. Respectively. So that's very, very thick margins that you see there as well. So that's all from me for China Shenshan. I'll now hand over the time to Paul.
Thanks. Next slide. Next. Yep. Next slide. Yeah. Yeah. Can I get the next slide?
Paul, is it lagging for you?
Yeah. Okay. Okay. I'll just start off with some macro highlights for Singapore. So we had some manufacturing activity, you call it the PMI. So that's relatively stable. You can see 50.6, 50.8. It's actually better than a year ago. In terms of the next data point we got was retail sales in Singapore. So that is picking up momentum. You can see in October 11.4. I guess the more pertinent one is probably supermarkets, especially for Sheng Siong. You can see that supermarket sales in October jumped. I guess with the lockdowns, September was 4, then now it's 10%. Just to refresh, pre-pandemic, supermarket sales was probably growing 2%, at most 3%. So the pace is still 4 to 5 times higher than pre-pandemic levels. So the fourth quarter numbers should still be strong. This is only one data point, obviously, for Sheng Siong. For healthcare, the numbers are a bit slower. You can see dental outpatients is slower, and also private hospitals is slower. I presume the surge in cases might have kind of impacted that. This is an unusual data point, average monthly earnings. So this is CPF contributors, what's the average pay like, the salary based on that. So you can, the nutshell is just that wage is climbing up in Singapore, and it's already above pre-pandemic levels. In the US, we had all the labor numbers. Unemployment rate, in the US is good. It's the lowest since the pandemic started. We had the Powell pivot. I guess they are no longer in the inflation is transient so for them, or transitory. So Powell has said that they need to wrap up the taper a few months sooner. So they need to stop buying back the treasuries and mortgage bonds as soon as possible, I guess. And I think this transitory inflation may not be probably used by him anymore, because he says that the risk of higher inflation has kind of increased. We'll run through later on the Altimeter growth spec. The spec that acquired Grab. We won't dwell on the valuation, I think, but we just want to go through the life cycle. We did this in April this year, but that was because the deal wasn't consummated and we didn't know there was spec in Singapore. So we just want to go through the life cycle later, just for everyone's benefit until we get the first spec here. We'll run through later the model portfolio for November, the performance. So tactically, it's all about Omicron. So far, the preliminary commentary from at least the Pfizer, I think you saw on TV, that he suggests the vaccine and antiviral drugs will work. Again, it's all early indications right now. Even our MOH here said that so far mild symptoms, although the transmission is higher, so it seems to be higher than the Delta variant. In terms of poems webinar, there's one more here. I didn't realize it wasn't on our schedule, but there's also Court Live on the 9th of September. So this will be the last 3 events. The last one on the 8th, this is more for the TRs, for Phillip TRs. Next slide. Okay, that's a bit of a while, right? It's a bit lagging. Okay, this is just the pandemic numbers. I think globally it continues to climb. I guess we might have a winter rise, the table on the left. But the good thing is the mortality rates have not climbed as much. So hopefully this is a sign that the vaccines are working. On the right, just a reminder, you can see this big spike. That's why the lockdowns are coming back into Europe. You can see in France, it's probably a 4th wave is happening. In Germany, you can see one in green, as I don't know, it's like 60, 70,000. The last high was 20,000. Next slide. Yeah, sorry everyone, there's a bit of a lag for me. Okay, for Singapore, I won't dwell too much. The good thing is that the cases are coming down fast. And I guess from the latest ministerial task force, they just said that they are going to step up border measures. These are the things that very little known on the infection rate incubation. I think we well know all this, but just for reference. Vaccine effectiveness thing, we can't figure that out. Next slide. Okay, in terms of manufacturing, nothing much here, just to show that it's stable. I think in Singapore, you can see the numbers are stable. Likewise, for globally, manufacturing activity is stable. Yeah, next slide. Anyway, above 50 means it's expanding, for what it's worth. Okay. Next. Okay, this is our model portfolio performance. Basically, Omicron decided the returns for November. So for us, what did well was Q&M. We got hit by Comfort because of the whole restructuring deal didn't pan out as we expected. And the usual, those that were affected by the whole virus opening were Escort, which surprisingly actually holding up pretty well at 4%. Yeah. So in terms of the table on the right, we are down 2.8. I think the market was down quite badly, 4.9 with the worst performance for the month. So we are narrowing our gap to less than 1% compared to the index after the severe drop in February caused by our Yoma exposure. Next slide. Yeah, next slide. Okay, this is the performance for the market in general. So you can see on the left, on the left, I think transportation was weak. I mean, it's expected. SIA. The better ones was actually the REIT others, like First REIT and so forth. In terms of the top 10 gainers, the table in the middle. So what did well in November were the glove makers and the semiconductor stocks. You can see from AEM and also UMS. Yeah, others were like Kimley, BRC, and QNM. The losers were the coal stocks and surprisingly even Riverstone and No Comfort and even MM2. Those were affected, and hospitality, those were affected by opening. In terms of the STI, this is just a recap for last month. At the STI, actually, there were no gainers in the STI. That's quite pathetic. But anyway, the best performer was ST Engineering with a loss of 0.5. Yeah, the worst ones were Dairy Farm, because I think Dairy Farm is affected by the exposure in Southeast Asia. I guess the new Omicron kind of raised the risk that there'll be more lockdowns affecting Malaysia, Indonesia. Next slide. Okay, next slide. I think it's taking too long. Yeah, next slide. Yeah. Okay. Okay. We're just going to run through. Sorry for the slow slides. We're just going to run through the altimeter. So this is going to be the typical life cycle of a SPAC since here. So when altimeter was listed, it was an IPO price of $10. The reason why it's $10 is I think they just want to avoid this penny stock. I think below $4 in the US. But what comes with when you IPO this SPAC, it comes with one share and also 0.5 of a warrant. So assuming in Singapore we get like 1,000 shares, then we get probably 200 warrants, free warrants. Again, the ratio may differ. I think Singapore could be 1/4 or 1/5, and these are in Singapore is tradable 1 month after. So what you will get is a share and a warrant. The table on the bottom, the red one, is that you will get redemption, at least for this deal, is about 100%. Singapore is minimum 90%, which is the same with the Nasdaq rule. So the commentary we have is that it's an IPO arbitrage. That's why a lot of hedge funds come into SPACs at IPO time, because it's almost like free money in the sense that you can redeem your $10, which is for altimeter, and then you get one free lottery ticket. I mean, who doesn't want? It's like the warrant is free, and that's why it's called default free, because the shares are redeemable at 100%. So you're 100% covered. So I mean, if you come in at a secondary market, you obviously don't get the warrants, and you'll be a bit disadvantaged. The other thing is the cost of this deal. So the cost is on the right. The sponsor will get free shares. So just remember that for this deal, there were 50 million shares issued at $10. So they raised 500 million. Of this, 20% will be given free to the sponsor. You don't see, I put here 15 because I'm assuming the warrants are converted and so forth. So they will get free. So if you do the math, it's 125 million, because if it's $10. They get it free if the deal is completed, if the de-SPAC happens. This is the other cost. The underwriters, the investment bankers, which I think like Morgan Stanley, they get paid 2% of the deal. I'm not sure for what, because this is like back 100%. Everybody will be scrambling for this deal. But anyway, there's also a deferred underwriting commission. If the deal happens, they will get another 17 million. So obviously the sponsor wants the de-SPAC to happen. The underwriters all want the de-SPAC to happen. You know, whether it's a good deal or bad deal, they want it to happen, otherwise they won't get paid. So there's something to watch for. the average redemption, there were studies done. The average redemption, most people actually redeem the redeem most of the shares. But again, this is just a study. Next slide. Okay, next. Okay, these are just other parts of the spec which is going to be very similar to Singapore. We just want to share with everyone. Yeah, just bear with us. So there'll be the free warrants that we mentioned. The warrants, the premium or the exercise price for this deal at least was 15%. So it could be quite similar to Singapore. It will be traded, I think for Singapore, it's 45 days from IPO. So these warrants can immediately trade, 1 month after. These are the founder shares, the deferred, I think we mentioned this. So for the D-SPAC is initial business combination, at least they call it in the US. It has to be at least 80%. So this one deal must be at least take up 80% of the value of the cash in shares. And if the deal doesn't happen 24 months, you get all your money returned. I think all of us know this. The other unique parts of it is that for Altimeter, they were not sure there's enough money yet to do the deal. So they had a forward purchase agreement. So they were also coming in event of insufficient funds. So they were also coming like standby money by the sponsor of 175 million, for 17 million shares. And also there's this thing called PIPE, which is a fancy term for placement. I mean, this means that there's also standby money that they could tap on this to raise cash, which the sponsor also was going to subscribe of 57 million. Just to give you a flavor of how the typical deal. And also the warrants, not only do you get the free warrants, you can actually redeem the warrants too, which is quite an amazing thing. But it depends on the expiration price and expiration period and share price. That part is a bit more complicated. Next slide. Yeah. Again, apologies for the lagging. It's taking a long time. Okay, I'm just took out the Altimeter share price again, just for us to get a sense of how did this particular spec traded. So at IPO, they actually did well. So whoever came in at IPO obviously did very well. The IPO price was $10. It traded at 11.89, although the volumes are very low. Then you can see at the bottom here, the bar is the volumes are very low. Then until you see this big blue bar here, that's when they announced the spec. So I guess if they announce the spec, maybe there could be a chance to get out. I'm not sure. Okay, but from there to then, you can see there's a lot of volatility. Maybe there's a lot of rumor of what will be acquired. Then from then on, it traded down from the day of the deal. Then I guess there's a lot of speculation, but I guess you get this pop when they announced who was the company that Altimeter was going to acquire, which is Grab, which is on the 13th of April. Then the stock will just drift. Then 14 September, it actually hit the low. And that's because Grab released their second quarter results. And they also cut their sales outlook. So maybe that was the low of about $10. Then on the 11th, this stock spiked back up again. You can see from the chart here to, I think, $17. Yeah. And that's because of the third quarter results. Then when the spec actually happened, when they had the vote on the 30th, and then when they got listed as Grab, you can see the share price collapsed back to, I think right now it's almost $9. So from 17 to 9. So I guess the thing to watch is when the D-SPAC actually happened is probably maybe we have to get out before. Again, it doesn't mean every deal will be the same. But for this case, it was probably better to get out before the actual D-SPAC event happened. Next slide. We try and explain why we think the share price dropped so much. But anyway, next slide. Is long. Okay. Again, this is just the warrant, just a reflection of the warrant. Obviously, it will move along same with the share price, but just wanted to share that at IPO you get $5. So remember, you get 1/5. So basically, whoever came in at IPO price, they make $11 on the mother share. I mean, $1 something extra, and they also get another $1 from the warrant, which is 1/5. Again, the volumes are very thin. You can see from the table at the bottom. But again, when the news announced, the stock was spiked up, and then when there were probably specific news on the Grab itself. Yeah, next slide. Yeah, I mean, it moves along, but surprisingly, the warrants are still trading, even though the mother share is like 11, such a huge premium. But you can 68. Yeah, but again, it also will collapse like the share price when the de-SPAC happen. Okay, next slide. Hopefully it's the last slide. Okay, anyway, this should be the last slide. Yeah, thanks everyone for bearing with us. So for this, I just wanted to show the table on the left. Probably the more important one was that when this deal happened, the original IPO investors in Altimeter, which is the 50 million you see here, the existing SPAC shareholders, so their float was they are only now 1% of the total float. So what we think is that there's a lot of shares coming in. You can see from the existing Grab shareholders, the 1.58 billion shares. So the original guys that came in only had 50. So now the number of shares out there has just, it's spiked up 31 times. So, and these guys, which is more than 40 funds, are probably the ones selling. And the table on the right, just to show you, this deal was valued at, if you take the 3.4 billion, they acquired Grab for 35 billion. But before this IPO, all the pre-funding rounds that you can see, again, these are from news articles. I can't verify whether it's the precise number or whether there were many more rounds. But you can see that the earlier rounds, the valuation, they valued Grab at 10 million. The most expensive valued Grab at, the funding was 10 million, sorry. The most expensive, which was 2 years ago, they valued Grab at 10 billion to 14 billion. So whoever came in at the late stage already get like triple their money. So their costs, I guess, is probably $3 or $4 at most. These were just my guess. At most, the most expensive one. So, but I presume these are the ones that will be selling since it's already $8 right now. So my comments is just that in theory, people like this SPAC because the belief is that when this de-SPAC happens, as a retailer, you can participate in like an IPO because it's like an IPO of Grab. But don't forget, there's a lot of other shareholders in this so-called IPO. The sponsor cost for this one wasn't low. So this particular sponsor actually put in a lot of money. You can see the sponsor related parties, the 77.5 million. So he put in 700 million. So that's why his cost isn't as low as the existing. His cost by 861. The other reason why people like to do this deal is because there's no IFA. And then you basically have to rely on the sponsor making a good deal. Of course, it doesn't help that he has 15 million, he has like a lot of free shares. So I'm not sure if that clouds his judgment. But it's like in a typical deal, if you acquire anything that's typically an IFA, to at least give a valuation of the stock of the target, for instance, for Grab. I don't think there's an IFA for Singapore too. So there's one way to bypass the IFA. And the third point is obviously this one, there's a lot of overhang. 50 million now, the float now jumped to 1.5 billion. So you can see there's a lot of shares coming up for this deal. This one is a bit unique, this deal, because they raised 500 million, but they acquired 39 billion. Most are not so big because the sponsor wants to have a lot of free shares. So this one just a bit unusual. And basically for this deal, you are the exit plan. I mean, my own thoughts. Because everyone's most expensive, like you said, the table on the right, everyone coming in valued at Grab at 4.5 billion. Now you value it. Now as a SPAC investor, you're valuing it at 35 billion. So obviously you're their exit plan, I guess. Okay, I think that's the last slide. Thanks everyone. Sorry for it's a bit of a delay, but I just wanted to show you what is the life cycle. It doesn't mean all SPACs are bad, but for this particular one, just wanted to show everyone since Grab is so into the headlines. Okay, thanks everyone. Yeah, you can go to Kim.
Hi, good morning. I'll kick off the Q&A session. I'll take some of the questions first. First question is on Digital Core REIT. The question is it a better buy than Capital DC given the better metrics? For example, price to book is at 1 times versus 1.8 times for Capital DC. Lower gearing of about 27% versus about 38, I think, for Capital DC. And estimated yield of 4.75 versus Capital DC's 5-year average of 3.7%. And a very strong sponsor, Digital Realty, with a blue ribbon roster of very strong cornerstone investors. So, okay, so just to provide some numbers here, For Capital DC, the current price to book is about two times, based on the share price of $2.38. Okay, currently for just based on this offer price of 88 US cents, Digital Core REIT's price to book is about 1.05 times. Yeah, but that being said, right, we do expect that there will be some price appreciation, and I think that, you know, for data center REITs, we don't expect them to trade the same way industrial REITs trade. We actually do expect them to trade higher. Yeah. Okay. So in comparison, just for some color, the sponsor, Digital Realty Trust, is actually trading at a 2.8 times price to book. Yeah. So definitely, I think the key story here is that yes, right now at this offer price, it does look attractive. If you're lucky to get the IPO, congratulations. If not, I think there will be we can expect that once the stock starts trading on SGX, it will start to climb. The share price will start to climb. Yeah. And for all of you who are wondering what the share price will look like at 2 times price to book, share price will look like $1.68. Yeah. Okay. And also earlier I mentioned about the sponsor and the rover pipeline. So this is where we think that the most attractive part about Digital Core lies. It is their rover pipeline. Yeah, because, you know, Capital DC, even though they have been very successful at unlocking portfolio value through asset enhancement and bringing on additional power onto their data centers, that has actually helped them you know, grow DPU very significantly, more than 20% over the past few years. However, there's also a limit to how much you can value add to your portfolio, and so Capital DC's you know, next wave of growth will actually come from inorganic growth. Yeah, and as I mentioned, you know, due to the consolidation in the data center space and among data center players, this rover pipeline is actually very valuable for Digital Core. Yep. And earlier I also mentioned that the sponsor Digital Realty is incentivized or is aligned and will be, and you know, they will still benefit even if they were to divest the assets to Digital Core. So at this point in time, yes, Digital Core at this share price or this offer price, it does look more attractive than Capital DC. So I hope that answers that question. I have several other questions on the REITs. So one of the questions is, core thesis for REITs investing is lower for longer interest rates. With Fed and most central banks turning hawkish, I'm concerned that, and I don't think my concern is misplaced. So I also, sorry, a related statement is about the S-REITs underperforming the market. Yeah, since Jay Powell turned hawkish on his tone. Yeah. So yes, so for S-REITs, you know, it is more or less inversely related to the interest rates, because don't forget that a large portion of the debt of a REIT's balance sheet actually comprises debt, about, you know, right now for the REITs above like 35% to about 40% leverage. Yeah, so of course that will increase the borrowing cost for the REITs and eat away at the profit margins. And also not to mention that when interest rates are rising, it also compresses the dividend yield spread, which is dividend yield minus the interest rate, or rather 10-year bond rate. Yeah, so that is another metric that investors also look at when it comes to viewing the returns on REITs. So in a sense, the REITs do lose out when it comes to periods where interest rates on the rise. Yeah. Okay. Another question. I like FCT for its predominance in suburban retail, but it has estimated 38% of leases up for renewal in 2022. This is a big headwind going forward for FCT, but it wasn't highlighted in your latest report. Correct me if I'm wrong. Okay, so for most of the retail REITs in Singapore, or rather Singapore retail assets, the WALE is usually about 3 years, or actually 2.8 around there. And that actually translates to, you know, about 1/3 of the portfolio expiring in any given year. And so that is not alarming for retail REITs. Okay. So for FCT, I think I mentioned in my report that as a they own a very dominant suburban retail assets. So that has actually helped them. Even right now, while the downtown malls are still having negative rental reversions, the suburban malls are actually beginning to show positive rental reversion. So this is very promising. Yeah. And for the management also shared with us that for most of the permanent leases that have been renewed, a lot of them are on the traditional kind of lease structure, which is higher, which is a higher percentage of fixed rents and a small percentage, about 0.5% of gross turnover rents based on the gross turnover, which is the revenue of the tenant. Yeah, so this is the traditional lease structure. And then like earlier in the year, rather in 2020, there was this talk about flexible lease, like higher risk sharing for the REITs. But from a tenant's perspective, if you are confident of maintaining or even growing your sales, you wouldn't want to have this higher participation or rather turnover rent to eat away at your profits. Yeah, and I think especially in this environment where a lot of people are tending towards using delivery platforms to fulfill their F&B orders. This is not really ideal for F&B players, because you're already paying like 30% commission to your Grab, your Deliveroo kind of players or service providers, and then you do not want a more variable component of rent that will also eat away. So overall, to sum things up, this 38% lease expiry in 2022 is more or less quite normal. I think for FCT, slightly higher because one of the assets, which is Century Square, it actually underwent a major AEI. So it was a major leasing year 3 years ago. So that means a lot of leases are coming due this year. So that also explains why leases for this year, for 2022, is slightly higher. Yeah, but overall, the suburban market, retail market is actually showing improvement. And a lot stronger positive rental reversions for some of the leases signed. Yeah, okay. Yep, so that's all for me. I'll pass the time back to my colleagues for now.
If possible, can you turn on the camera? Thanks.
Okay, sure. So I'll do the next one. So yep. So give me a moment now. Okay, so okay, so guys, can you if you can look at my screen and hear me, I'll just type 1 into the chat box, and I'll before I carry on. Yep. So okay, so let me see. Yeah, okay, thanks. So the first chart, before I go and dive into Q&A, just I'd like to go through, since there's one question on the banks, on OCBC, I believe. So I'll just go through the STI and then was it on. So basically STI for the whole last week, it has a very unnudged selling. Like the whole of like last week, all right, there's a very strong selling, came out and then touched at a very extreme bottom at 3037. Subsequent rebound was all right. There was a harami pattern followed by a smaller harami and then breaks up. So right now, price did open fairly good in response to what the US future, the US index futures, the Dow and the S&P 500 futures, it trends up. So price is relatively doing well right now. So we are expecting some sort of upside moving on ahead. Okay, so yeah. Okay, so yep. So that's for STI. So for the banks, let's start off with the largest one. The largest and most popular is the DBS Bank. So DBS Bank sell down did occur and then did rebound at the above segment mentioned support zone, although it did had a strong bearish downside. Last, I think 1st December, it rebounded strongly thereafter. But do remember that there was a bearish breakaway gap over here. So we are still looking at this level of at around 32.35 and 32.25 region for a test. All right. Expect some sort of minor correction if there is, and then price will just resume going to the upside since there was a strong rebound on the support zone itself. For OCBC, you can look at it. Ichimoku is still showing a very strong downtrend. This kind of movement at the key support zone between 11 to 11.23 was like a good rebound. First up, I think today it opened up with a very good bullish candle, but just that price still maintained within or below all the 5 Ichimoku indicators. The good thing is it's extremely oversold of an RSI, no divergence seen. But you know, ADX is still picking up with the DM minus dropping down. So once ADX cross above the DM minus, it signals that the price is going on the trending up over there. Also, the previous crossing out above the DM plus shows that there is a sound lag. So DM plus is is seeing sign of picking up, gaining strength. So expect some breaking above 20 will confirm the upside. So yep. So for UOB, it's the same thing as well. Price actually has had a false breakout. Quickly, price returned back above the larger ascending triangle upper sloping line. Just that, you know, price still remain just price break above Senko span A. So we are seeing some sort of little above upside to around $27.12 region before we see some sort of further consolidation. Moving on to ISDN, there's a large consolidation over here. Within the consolidation, you can see that there is a potential head and shoulder pattern. So neckline resistance remain at around this level between 0.55 to 0.595. Price although do have a bullish breakaway gap to the upside, but the resistance was capped at 0.785. So this formed the right shoulder. We can see that price actually it might be going to consolidation once there is a crossing. So whenever you can see the past pattern, it really when it cross actually the DM minus and plus cross together with the ADX, can see that prices actually go into a very tight range. So for that, I remain neutral on ISDN itself. Next, I'll go through Mapletree Industrial. So Mapletree Industrial today has a gap, opening gap above price with a strong bullish candle. We expect the corrective trend to target 255 to have a very grand and super strong bullish rebound. So any immediate upside will likely find cap at resistance at $2.77 for now. The best case scenario will be have a false breakout above the broadening wedge at 280, and then before a correction down to the downside again. So that's the thing that I see in Mapletree. For Rex International, downside corrective is still ongoing. I expect prices to actually go test 0.23 to 0.25 support zone moving forward, going forward. All right. So for the next one, SIA Engineering, I shared this on the weekly chart before. I think that was like last webinar. So in the midterm, I expect price to actually target the $2.61 to $2.70 resistance zone. Unfortunately, it just came down and find a daily support over here at around 219 to 255. You can see that there's excuse me, there's a rebound to the upside. So I expect some price to actually further rebound going further. So what my thoughts is that we might see one more correction down at $2.40. So if this come down very strongly, then we might see that there is a very strong downside to break above, then to target slightly earlier on the $1.50 and $1.69 grand support zone in the longer term period. It should $2.40 fail. Sets breakdown of the ascending triangle. So this is likely a bull trap, and then price find its support. But I think that any upside will likely to be consolidated, and then pushes price down down some more. $3.38, and this gap zone is likely to be a better rebound zone going forward. You can see from the weekly chart, yes, this is likely to be the case. You can look at if you want to do it in an Elliott wave kind of manner, be one first wave, second wave, third wave, fourth wave, and fifth wave, and then you have A, B, and then we have C wave over here. So this is the likelihood of the movement for sets on the weekly chart itself. All right, so next one, someone asked about Top Glove. I think Top Glove momentarily upside is kind of limited. Judging from the Ichimoku is still on the downside. Despite it breaking up, I have forewarned that $1.04 and $1.10 is really a key resistance level that to be really be cautious of, and the sell down did really occur. So I think that the rebound at 0.75 support zone likely to happen, but it's not going to be very strong. All right, so I think overall Top Glove, this is really a one-time event based on Omicron or whatever variant that it actually says. All right, so for Q&M, price actually reached above the immediate resistance at 6.7. So price had a short-term correction, bearish and engulfing candle. It was here, and then a shooting star is now appearing. So we do expect some sort of mean reversion back down to 0.57 to 0.595 support zone 1 again, since it break out of the symmetrical triangle. This support zone should hold in order to validate the symmetrical triangle, and then a brand new rebound to a newer high at 0.690. Razor, someone asked about Razor earlier on, so I don't know if you mean the technical or the what's the outlook or the fundamental outlook it is, but based on technical, it actually has already achieved beyond my target price to based on my October report. So the pattern has failed, obviously, has a strong breakdown, and then price actually tested the resistance and support zone at $2.31 to $2.32, rebounded, and then retest again. But the second rebound wasn't that fantastic and strong. So hence, I believe that there will be one more downside into 0.206 going on further. I think at the most case scenario, looking at ADX, we are looking for a consolidative trend. Right now, ADX has already peaked on top, so we can see that trend is likely to be going into a sideways consolidative trend. We can see our Maple Tree Logistics.
The reason there was a privatization at 282. Yeah, just for your info.
Oh, okay. So okay. Didn't know about it. Yeah. Okay. So thanks, Bob. Yeah. Okay. So Maple Tree Lock. Yeah, Maple Tree Lock. Yes. So price actually came down. So although there's some sort of like bullish candle that can be seen over here, but we expect the price actually based on the weak bullish consolidative candles over here, we expect price to come down at $1.80 before rebound, and this gives us that okay, there is some buying pressure, that there's interest in buying pressure over here. So we expect that any correction down, we expect that buying opportunity to be fulfilled at around $1.80 based on the technical chart that is seen above. You can see the ADX price, the DM plus is actually going on to the upside. Genting was relatively good. I think price fails to breaks above and then rejects down. I think price is going to look for some upside to retest the upper resistance zone again going forward. China Merchant Bank breaking out of falling wedge, rounding bottom. So there is a strong upbreak to the upside again. So let's see how is it going to be like. I think for the Chinese banks, I think based on technicals, we are looking at a very strong buying demands over there. So the next one is Wilmar. And yeah, so Wilmar has a rebound over here. Can see that there's like not really a strong morning star, provided this end up with a great bullish signal, and then then we'll be seeing a good outside for that. Someone asked about Alibaba. Okay, so I think Alibaba, I'm not very strong on that. So first of all, Ichimoku is showing obviously a very clear bearish downtrend. Despite it gaps down, despite a trend up, a bullish candle, I doubt it will sustain pressure above. So for Alibaba, I would think that I'll look at $102 Hong Kong dollars instead for that, for Baba. All right. So before I end off, let me see SGX. So SGX, after last Monday's failed Morningstar candle, it came down and then price successfully goes up. So if the DM plus is going to cross above the DM minus and the ADX at the same time strongly and then cross above 35, then we can see that price is expected to test immediate upside at $9.65 to $9.75. C Limited. Okay, so for C Limited, I think it has already, there is a bullish candle, but the upside, I think that is not going to be very strong. I think if you can look at a larger weekly chart, you can see that this correction has been clearly very strong down. So we expect some sort of like a one more down move to 199 to 211.11 for that. Okay, so okay, so next one it will be I'll do city development in view of time. Okay, so for city development, I'm expecting price to actually price didn't really react to rebounding at $6.92 based on my last sharing. So I think price is likely to go down to 658 to 671 for rebound going to the upside again. Okay, so let me see one last time. Okay, so I'll do straight trading, falling wedge. So we are looking for an upside break. Let's see how is it going to be like right now. Okay, and then Capricorn rebound at my key support zone nicely, but price movement due is not really that fantastic for now. So we might see a further consolidation over that. Okay, so so I think that's it for now. Wilma have done. Okay, so I'll pass my time back to my colleague. Thank you.
Okay. So I can't. Some questions we really not sure how to answer. Jonathan, have you seen the result? The high power Razer privatization? If I accept, what must I do? I'm really not clear. Yeah, on because this is the Hong Kong stock, so we don't really cover Hong Kong. So yeah, apologies. Not sure how to respond to that. Yeah. You mean the process? Not, yeah. So I'm not too familiar with the question. Yeah, apologies for that. Yeah. Natalie, you want to take on this one? Out of the few key, which are the better options. I'm not sure if you've done that. And also, Timothy, you got one question on the. There's one on the chat. Whether are you proof of work or is it proof of stake? Yeah. Timothy, I'm not sure if you can help out on that. Okay, this one I can do. This one's the easy ones I can answer. Like, where and when can I get a replay of today's session? You can get it on the YouTube, hopefully by end of today or early tomorrow. We normally post it in our PhillipCapital YouTube. Yeah. Thanks for that question, because it's the easy one I can answer. Yeah. Timothy Pendegree.
Yeah, okay. The question for me is, hi team, if one Bitcoin equals to 50K USD, does it mean that Mara's daily profit is about 3.3 million? Okay, Marathon doesn't earn a profit now because they don't sell their Bitcoin, they just hold it. So it will be their revenue. And actually, with regards to the 75 Bitcoin, actually after referring back, that is their target 75. So that will be the target for the end of next year. So currently now they are mining only about I think about 15 Bitcoins per day, and they earn about 50 million revenue in the last quarter. But the 75 Bitcoin mining capability is what they target for the end of next year. Okay, I hope that clarifies. There's another one in the chat. You're saying that whether I'm confusing the proof of work, which is the verification, and the proof of stake, which is the mining. Okay, of work, I only went through proof of work. I didn't go through proof of stake. But actually, I'm not so familiar with proof of stake also. But how proof of work is done is that in order for a Bitcoin miner to actually update all the transaction data that everyone has, and to make sure that it's very hard for anyone to fraudulently change, to put in a fraudulent transaction data into the system, is that they had to do a lot of work in order to do that. And because it's so much work, it's very hard for you to it costs you a lot to do the fraudulent transaction, first of all. And second of all, it's very hard for you to control the whole system, so that you can take control of the whole system and start mining a lot of Bitcoins and start changing a lot of the transactions yourself. Yeah, I guess that is proof of work. Yeah, Bitcoin has no proof of stake. There's only proof of work. So I only went through, for Bitcoin mining, it's only proof of work. Yeah, but I'm no expert in this. This is just what we got from the Marathon Digital webinar, but that's how it works. And thanks for the question. I think that's all for me.
So maybe just a quick one on Japfa. Saw that there was a question on Japfa. So the last update that we did for Japfa, mainly they are dependent on they are affected by the prices of the broiler and the day-old chicks, and the sales volumes have remained stable due to the fact that what they sell are perishable goods, but the prices have basically fallen quite a lot. So for example, for the PT Japfa DBK, which is the main revenue contributor, it was basically selling this broiler and DOCs at a loss. And the feed, which remains their pillar of profitability, they are seeing higher raw material and shipping costs for this also. So this kind of like squeeze their margins. But on the other hand, poultry prices have remained fairly stable. And for the animal protein the APO, which is primarily in Vietnam, the broiler prices were also below cost and swine prices also dropped. And similarly, the feed, for the feed part, they also saw tighter margins. But the dairy segment still remains very strong with China's raw milk supply in shortage. Yep, so hope that helps. Thank you.
Natalie, you want to take the last few? I'm not sure if you already answered it. Then we can end it. Thanks.
I think she mentioned her comm crashed, so she's restarting.
Okay, I'm not sure if everyone wants to. Yeah, apologies for, I think she has some technical issues. We just wait 1 minute before we end it. But just as a reminder, next week on the 13th will be our last webinar for the year, because most of us will probably be on away on leave. Okay, I think I think not to hold back everyone, since we're not sure if she's coming back on. So I think with that we can end the session. So thanks everyone for your time. Apologies for some of the technical issues today. Next week will be our last webinar for the year, and hope to see you and have a good week ahead. Okay, take care everybody. Bye bye.